Welcome to It's the Economy. Today our topic obviously is Jerome Powell's dovish tilt in the much-awaited speech at Jackson Hole in Wyoming. Let me quote, "The time has come for policy to adjust," Powell said, confirming the expected rate cut in September. And though he said that the timing and pace will depend on incoming data, the fact that he said two things are important. Let me quote him. First quote, "We do not seek further cooling of labour markets." And second quote, "We will do everything we can to protect the labour market." This has led to some expectations of a 50 basis point cut in September. To parse Powell's speech in detail, we have with us an expert, Robert Sockin, the global economist at Citi. Robert, I can't tell you how grateful I am that you have sat up for us. Well, first, your key takeaways from Powell's speech. How many cuts do you see on September 18th? Of course, I think Powell has made it clear there is going to be a cut.
Yeah, absolutely. And the first thing to note, as you mentioned, is that Powell made it very clear that now is the time for rate cuts. I think there should be no doubt that some form of cut will come at the September meeting. And now the debate really comes around the timing and of cuts after that meeting and the pace of rate cuts once that easing cycle starts. Powell did not commit on that front and really said it's going to depend on how the data evolve. Right now, the way the data have been evolving, it feels like the Fed is going to start with a 25 basis point rate cut and then move at a 25 basis point cadence for at least several meetings after that. Our U.S. team thinks, though, that the data are going to deteriorate more from here. And if that is the case, then you would start to get the Fed to move at 50 basis points in September, and maybe even another 50 after that, which is their base case. So it really does come down to the data here. I'm watching the next employment report in particular very closely, but the data over the last few weeks suggests to me that the most likely move at this stage is a 25 basis point cut in September.
Okay, let me take you up on this 25 basis expectation. Let me read one quote from Powell's speech that I thought sounded emphatic. I quote, "We will do everything we can to support a strong labour market as we make further progress towards price stability." End of quote. Yes, there is a caveat of price stability, but everything we can, wouldn't this point to a 50 bips cut?
Yeah, that's a great point, and to highlight that passage. And I think one thing that's clear is the Fed is not really as concerned about inflation as it was a few months or a few quarters ago. They really see that the upside risks to inflation have diminished significantly, and now they're more focused on downside risks to activity. So far, the unemployment rate has moved up to 4.3%. From a low of around 3.4%. And as many have noted, the SOM rule, which has been an excellent indicator of recessions, has been hit as of the last employment report when the unemployment rate moved up to 4.3%. That being said, there are a lot of caveats in this cycle. A lot of the rise in the employment rate has been due to an increase in labor supply that has been fueled by a large immigration boom. So Powell is watching these same data and saying that right now the labor market is looking manageable and is cooling in a manageable fashion, but they cannot ignore that rise in the unemployment rate, and any more at this stage would be very unwelcome. So, for example, in the next employment report, if the unemployment rate were to jump to, let's say, 4.5%, even if that was due to increasing labor supply, I think they would be concerned enough by such a large move that they would start moving at a 50 basis point tenor. So I think what that statement means is we're watching the labor market closely. If it gets worse from here, we're going to react. But as things are right now, we think we're getting that soft landing still.
Okay. Well, Robert, let me just explain. You said SOM rule to our viewers. SOM rule basically means that if the 3-month average of unemployment is higher than the 12-month low, which was the case last time. 4.3 was the average and the 12-month low was 3.6. So if it is 50 basis points over the 12-month low, then the US is already in recession. That's the SOM rule that Robert is referring to. Robert, I'll come to that in just a minute. But first, what is Citibank's August employment numbers? Will it be just around 100,000 non-farm payrolls? And what is your unemployment rate, more importantly? Will it be 4.3?
Yeah, and this is where the difference comes from where the data have been looking now to what our US team is forecasting in their base case. They think that the rise of the unemployment rate to that 4.3% is just the beginning, and you're going to get a continued rise of the unemployment rate through year end and to getting somewhere into the 5% range. So they're very much looking for things to deteriorate further, and that's why their base case is for a 50 basis point cut in September and another 50 basis point cut in the meeting after that. To me, as I said, right now, the data aren't so clear. We've had some weak data in early August. More recently, we've had some stronger consumer data with very strong retail sales, and jobless claims have been very low. So I think the jury is still out on which way that data will go. If the data continue to, as they have in the last few weeks, I think you're going to get that slower pace of rate cuts. But right now, yes, our U.S. team thinks things are going to get much worse from here, and that's going to lead to a rapid pace of rate cuts from the Fed. So that employment report that's coming out right before the Fed meeting or relatively before, that's going to be very pivotal for what the Fed does in September.
Okay. In that case, what are your forecasts of rate cuts for 2024? You are in the 5 cuts camp?
Right now, yeah, our U.S. team has 50 basis points in September, another 50 basis point after that, and then 25 basis points. You get 125 basis points in cuts in total, and then continued cutting into next year. But as I mentioned, if the data continue to feel resilient and something that's more like a soft landing, the Fed probably does 3 cuts this year of 25 basis points and moves at a very gradual pace. One other thing I'd like to note is I think what we've seen around the world is central banks in general have opted for gradualism when they can. All other central banks have really started their rate cutting cycles with 25 basis point moves. If you look at the ECB, they started with 25 and then they paused to see how things were going. So I think central banks are being very cautious in this environment. And unless you get a real weakening in US activity from here, I think the Fed's going to be cautious with those rate cuts as well. Now, again, if we're going to a recession, all bets are off. But if we're not, I think you're going to see a cautious pace from the Fed.
Okay. Now, if you are right about cuts, that is 5 cuts, and you're expecting unemployment at 5%, then you are already in the Salm rule camp. That is, US is already in a recession or very close, perilously close to one. In which case, aren't the markets too exuberant?
Yeah, absolutely. If our US team is right and you are going into that recessionary environment and the rise in unemployment rate that we've seen is just the beginning and you really do get a sharper deterioration on the labor demand side, then that would be, I think, relatively bad news for the market. Now, our US equity strategist still thinks that in a recession, the market can be fairly resilient because you have a lot of other stories going on in the background, still some AI, still part of the AI story. You'd start to get a rapid rate cutting cycle from the Fed. So there are a couple of things going on that can keep equities a little more resilient. But certainly the euphoria that you've seen in the markets, that's much more of a soft landing flavor than a recessionary flavor. So I do think if that is the case and you get that recessionary environment, you're likely to get some pullback relative to where we are in markets, just because right now it does feel like things are generally pricing in a fairly soft landing scenario.
Well, AI is good for some, but not good for all. Anyway, let's stick with the fixed income markets. What are you expecting in terms of levels for the US 10-year yield? What's the range? And what's the range for the dollar index? The DXY is already below 101, and the 10-year yield is below 3.8.
Yeah, absolutely. On the 10-year, again, this debate that we're having right now about how fast is the Fed going to move, that is very important for where the 10-year is going to be in the short term and the medium term and the long. It's if the Fed does stay a bit higher for longer, you could get a 10-year somewhere in the low fours. For a meaningful period. If the Fed starts to cut very rapidly, I think you start to move below 4 on a pretty durable basis. So I think low 4s in a higher for longer Fed and you go below 4 in a rapid cutting cycle, and probably somewhere, I think, into the high threes would be more fair value, somewhere in that 3.75 to 4 range. That's on the 10-year. On the dollar, again, it's going to depend, I think, on this rate cutting cycle. Again, I think if you start to get a fast rate cutting cycle, you could get more of a pullback in the dollar, especially if it's just the U.S. that's slowing down while other economies are picking up. But it's going to depend on that global picture, because a U.S. recession isn't always negative for the dollar. If the rest of the world is slowing down, you get this risk-off sentiment. People tend to move into safe havens, and the dollar could even do relatively well. But I think in an environment, if our U.S. team's right, where it's just mostly the U.S. slowing down, I think you can get dollar depreciation from there. So it's really a scenario analysis in both cases.
I agree with you, but actually the U.S. exceptionalism still seems to continue. But let me come to, there are other questions. I don't have time to discuss the impact of the Robert Kennedy factor, him teaming up with Trump. We'll push that discussion for another day. Let me just end by asking you, where do you see India? Do you think we get bogged down by a U.S. slowdown, a China slowdown, or do you think India remains resilient?
I think India is going to continue to be resilient. I've talked a lot about on this program that India has been one of the best performers in our forecast, has been consistently surprising us to the upside with its resilience. And if you look at emerging markets in our forecast, they grow in aggregate about 4% this year. They grew in aggregate about 4% last year. So we're looking for no slowdown overall in emerging markets, some mixed shifts in terms of different economies, a few slow down, a few pick up. But India is one of the ones that had very rapid growth last year and holds up very well this year. And I think going forward, as the global manufacturing cycle picks up more, we're going to see that benefit India. And we're also going to see India benefit from longer term from a lot of other issues we talked about in the show, like very favorable demographics, favorable improvements in mix and policy. So I think India is a very positive story for the global economy, a very positive EM story, has been, I think will continue to be going forward.
Okay, actually, you're a good omen, Robert. The index, the Nifty, has crossed 25,000, even as you were saying, that India remains a resilient story. Thank you very much for joining us and staying up late for us. We wrap up on Bazaar on the note that the index has crossed 25,000, racing to its all-time highs yet again. A strong note to end Bazaar. Chartbusters coming up.